Yes, next up. Wow, Chris, that was awesome. We knew that was going to be a good story. Thank you very much. Oh, we're fortunate to have you and some industry champions with us. We need stronger voices like this in our industry. I want to take a moment and thank all of our Williston Basin Petroleum Conference sponsors, especially our diamond sponsors. Crowley Fleck, Enerplus, KLJ, Lund Oil, Martin Construction, Neighbors, NDSU Foundation, Dakota, Petro Hunt, PTRC, RDO Equipment, SandPro, Valence, and WBI Energy. Let's give them all a round of applause. Now, our last session this morning is going to be fantastic. We have with us Todd Slawson and Neel Kashkari. We're just getting going here for this morning's session. Next up will be our Petroleum Council, Chairman of the Board, Todd Slawson. He's going to have a discussion with Neel Kashkari, President of the Minneapolis Federal Reserve Bank. Neel is no stranger to this event. I believe it's the third time you've been here, Neel? This is awesome. He has presented several times, and I vividly recall one of those times, Neel, you made the comment that was, the technology developed in the Bakken has had a bigger imprint on the world than the iPhone. That's quite a statement, and I think we are living up to it, Bakken. We're going to see what Neel has to say today. Along with Neel, we have Todd Slawson. Now, Neel is the president of the Minneapolis Fed, one of the Federal Reserve's 12 regional banks. The 9th District, which is what we are, is made up of Minnesota, Montana, North and South Dakota, northwestern Wisconsin, and the Upper Peninsula of Michigan. Neel serves as a member of the Federal Open Market Commission, where he sets the nation's monetary policy. Now, some of you may know that a few years ago, I served on Neel's board of directors for the Minneapolis Fed. And I remember when I was asked to do this, I said, I'm a geologist. I am not a banker. What do you need me on this board for? And the answer was, we have an entire bank full of bankers. We need business people. So thank you, Neel. I really appreciate the time I got to serve and help on the board. And I will tell you part of my role was living in Tioga, North Dakota as a geologist in the heart of the Bakken. My job was to attend the board meetings about 8 times a year and bring the story of the Bakken from Watford City and Dickinson, Tioga and Ray and Williston and Minot, and take that story right back to Neel and to the board at the Minneapolis Fed. And from there, Neel took that story directly about our industry to the Federal Open Market Commission. How cool is that? We had a voice directly to Washington, D.C. monetary policy. So thank you, Neel. Neel began his career as an aerospace engineer, developing technology for NASA space missions, a literal rocket scientist. He later held a variety of roles in public service and finance, most notably as the Assistant Secretary of the Treasury during the 2008 financial crisis, where he oversaw the Troubled Asset Relief Program. Many of us remember TARP. Neel lives with his wife, 2 young children, and Newfoundland dog in Orono, Minnesota. Please help me welcome Todd Slawson and Neel Kashkari.
Welcome, Neel. Thank you for coming to Bismarck to present in front of this conference today. We really appreciate it. First of all, did you stay up last night to watch the Denver versus Minnesota game?
I wish I did. I did not. I was tired. I went to sleep. Thank you for having me, though.
Yeah. Are you a Timberwolves fan?
You know, I'm really much more of a football fan than I am a basketball fan. I know my Minnesota friends are going to be outraged at me saying that, but I'm a football guy.
Okay, just in case you don't know, Denver won. Otherwise, I wouldn't have brought it up. So you're an aerospace engineer. Where are you from? Where did you grow up?
I was born and raised in Akron, Ohio. I studied engineering at the University of Illinois. As Kathy said, worked in aerospace for a few years before I went back to get my MBA and went into business and finance.
Okay, good. So you're speaking to a group of engineers, geologists, salesmen. There might be some bankers in here. So I kind of want to set the stage a little bit by talking about why there are 12 branches of the Federal Reserve versus one. What are your mandates? What's the FOMC, which is the Federal Open Market Committee? Can you kind of set the table a little bit and kind of
Sure.
explain those?
First of all, let me say thank you for inviting me back. It's great to be here. The U.S. Congress created the Federal Reserve, our nation's central bank, in 1913. And our basic job is we do a bunch of different things, but one of our basic jobs is to try to manage the ups and downs of the U.S. economy. If the economy is growing too slowly, we will traditionally cut interest rates to try to give it a boost. If the economy is overheating and inflation is too high, like recent experience, we will raise interest rates to try to tap the brakes on the economy to bring the inflation back down. In 1913, when Congress created the Federal Reserve, they did something unique. And they wanted, just as Kathy said, they wanted all the different regions of our country to have a direct voice in that policymaking process. So they created the Board of Governors in Washington, D.C., and then they created 12 independent Federal Reserve banks. And our jobs at the Minneapolis Fed are to represent all of you. And that's why we have a board of directors made up of business leaders from all across our region. Kathy served for 6 years. We have Brenda Foster, I'm not sure if Brenda is here today, a banker from North Dakota who's on our board right now, and others over time that contribute their wisdom of what's happening in the regional economy, bring it back to Minnesota, and I take it back to Washington, D.C. So our mandates as it relates to the economy are stable prices, what we define as 2% inflation. I don't need to tell you that we've had much higher inflation than that in recent years, and maximum employment, as many Americans gainfully employed and contributing to our economy. Well, typically, if you see that if inflation is too high, we'll raise interest rates to try to bring it down, or if inflation is where we want it to be, but the labor market, there's a lot of unemployment, we will traditionally cut interest rates to try to bring it back into balance. And so that's, walking or traveling around the region is a big part of my job to get to know what's happening here in the economy in this part of our district. And then ultimately, we have to make the best decisions we can for the country as a whole. We can't set a different interest rate for North Dakota and California and New York. We have to try to pick the monetary policy that's right for America as a whole. But my job is to make sure that this region, and my colleagues' jobs, are to make sure that this region has a direct voice in that process. And so that's why I'm grateful to be here and hear from you today.
You mentioned one of your mandates is basically a 2% inflation rate that you're trying to get, and obviously the last 4 years we've been well over that. So what caused this inflation?
It's a confluence of events that surprised us, to be honest with you. Let me just go through them very quickly. First of all, COVID hit, the services economy was shut, and there was a lot of stimulus put from the government to try to support small businesses and families who lost their jobs or whose businesses were shut. So when a lot of money went out into the economy at a time when the services economy was shut, you know what we all did, you and me? We bought a lot of goods. So we said, well, we can't go to restaurants, we're going to buy more goods than we normally would have. At the same time that those supply chains for those same goods were gummed up because of COVID and because of the pandemic. So you saw skyrocketing inflation on the goods side of the economy by more demand for goods than is normal and supply chains for those goods that was gummed up. And those supply chains took a lot longer to get healed than we appreciated, than we thought was likely going to happen. At the same time, and much closer to home in this conference, Putin invaded Ukraine, sending oil markets to the roof, sending commodity markets to the roof. And oil, as you know, is a very important input to the global economy. When oil markets and commodity prices go through the roof, that sends an inflation shock wave all around the world. So that happened at the same time. Obviously, oil prices have stabilized relative to Russia invading Ukraine. Commodity markets have also stabilized. One piece of good news is that when Hamas attacked Israel, we did not see that same price response from the oil market or from other commodity markets. That's good news from the Fed's perspective, that it keeps the inflation, at least another shock from hitting the economy. That didn't happen, I think in part because of the work that you all do to effectively try to put a cap on some of those high energy prices. So it was a confluence of events. Some of those things have gotten better. The supply chains have mostly gotten better across most sectors of the economy, so that's good news. We haven't seen further increases in commodity prices, as I just said, from the Middle East, but there's still some underlying demand in the economy that we're focused on now to get it. Inflation's come way down from where it was. It went from a peak of around 9% to somewhere in the 3s now. We're still well above where we need to get to, but we've made a lot of progress over the course of the last year.
So you mentioned that basically we're down from where we were to begin with. In the second half of 2023, basically inflation dropped. It was looking good. We're on a good path, and things seemed to kind of rebalance themselves. And basically the last several months, we've seen indications that inflation's kind of back up again, even though we see a lot of mixed signals. I mean, the April jobs report came out and said, okay, maybe it is cooling a little bit. So what indicators are you really looking at? There seems to be so many tea leaves out there to read. What are you looking at that's important to you as the symbol for what inflation's doing?
Well, as you said, we look at a lot of different data to try to get a read on where the economy is going. And so we pay attention, of course, to oil prices, because as I said, oil feeds into just about everything across our economy or broader energy markets. We're looking at the actual inflation data. A lot of our economic models, we've got very sophisticated models to try to predict how the economy is going to respond. Those models have not done a very good job given those unique dynamics that I just described. So we have to pay more attention to what's happening to actual inflation and to what's happening in the real economy. So that means, you know, our American spending. People have been spending a lot more than I would have guessed given where interest rates are. So consumption in the economy has been higher than I would have guessed. As much gloom as there appears to be when people are surveyed about how they feel about the economy, most people are spending like they feel pretty good about the economy. If you go on airplanes, they're usually full. If you go to restaurants, they're usually full. If you go to hotels, they're usually busy. So people tend to be spending more money. The savings rate has gone down. It used to be around 7%, now it's around 4 or 5%. That seems like a small change, but at the scale of the U.S. economy, it's actually a lot more spending than we had before COVID hit. And then I pay a lot of attention to the housing market. Housing is a big driver of inflation, a big driver, a big thing that people spend a lot on. The housing market has been much more resilient, despite the fact that mortgage rates went from 3 to 7.5 for a 30-year mortgage. The housing market has been much more resilient than I would have expected, given those big mortgage increases. We think that's for a lot of different reasons. We think that there's a pent-up demand for housing. There's been a pent-up shortage of housing across our economy for the last decade, and people are still feeling like they just need to go out and buy, or leases are now ticking up again. So housing is probably the area, I mean, we're focused on a lot, but housing is an area that I'm very focused on right now.
Yeah. Talking about housing, it just seems like we're in a weird situation that I haven't ever seen before. Mortgage rates really dropped low, to some percent, and maybe I'll ask you why they dropped so low. People got great mortgage rates, but they seem to be locked into their homes. They will never see those mortgage rates again that low in their lifetime, and they're not selling their homes. So those homes aren't coming back on the market, even though a lot of those people want to move. Interest rates are so high, interest rates are so high that basically developers can't really go out and start new housing, projects, apartments, and single home, stuff like that. And then basically PE firms are buying houses and creating single-family rental homes, which we haven't really seen in the market. So how do you solve that issue with people who are locked into their homes? Is it maybe a good idea that maybe that thing can travel with them a little bit to the next home? I know you can't do that, but how do you solve this housing issue?
Well, this is not unique to this time period. You know, 30-year mortgages have been around in America for a long time. If you look back in the late 70s and early 80s, when the Federal Reserve raised interest rates aggressively to bring inflation down, people also had this lock-in effect, and there was a big spread between current mortgage rates and the average mortgages families are actually paying. So that's not unique to right now. And this notion that people aren't selling, I agree with you, you're right, but those same people also aren't buying. Most people who buy a home are leaving a home. And so it takes supply out of the market, but it also takes demand out of the market. So I think that story gets a little bit over too much attention because it affects both sides of the equation. Long term, we know that monetary policy can bring inflation down. The big question mark in my mind is how restrictive is policy right now? I would have told you, relative to the pre-pandemic, having mortgage rates where they are and having the federal funds rate as high as it is, mid-5s, that would feel like we'd be putting 2 feet on the brakes, slowing down the economy. It seems like there's more resilience in the economy than I had expected. So maybe because of some of these dynamics, these interest rates only really mean we're putting 1 foot on the brake and not 2. And so there's a lot of, the biggest uncertainty in my mind is how much downward pressure is monetary policy putting on the economy. That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
So basically, you're seeing the economy is good right now. Basically, things have rebalanced themselves, and things are kind of ticking along a little bit. And you know, at the first of the year, they were saying, hey, there's going to be 6 cuts, and then people say, well, maybe there's 2 to 3, and maybe there's 1 to 2 coming up. Maybe there's 1 after the election, and now it's kind of looking like there might not be any cuts. I know you can't project that or say that, but it seems like it's changed, and you've kind of said we're not. Maybe the policy, monetary policy, is not restrictive enough. Maybe it needs to stay here for a while, which is your wait-and-see approach. Or some people said, well, maybe it needs to come up a little bit more to knock it back down again. And so that's kind of what you've been saying is that path forward. So let's talk about the current situation with banks. Right now, they're in a tough situation as well. People have pulled their deposits out and put them in Treasury bills and other institutions where they can get a higher interest rate. They're not getting any loans made because, like I said, the development and it's just rates are too high. They're in a kind of an unprofitable situation. How do you see help for those banks?
Well, I think when I talk to a lot of banks, and I'm going to be seeing some this afternoon, they're a little bit more optimistic than I think you just described. You know, traditionally, a higher interest rate environment, banks make more money because they can lend money at a relatively higher rate. And while their deposit costs have gone up, consumers tend to be slow to actually move out to money market funds. And so banks generally are quite slow in raising their deposit costs. And so it ends up being a more profitable environment for them. You know, just backstage, this is an anecdote, just backstage, a nice woman was helping us. She said in her day job, she's a mortgage banker. And I said to her, and I'm not going to out her, I'm not going to say her name. I said, well, how's business? She said, oh, we're so busy right now. I said, how can you be so busy right now? She said, well, we're making a lot of FHA loans and VA loans. And I said, what are the interest rates that people are paying on those FHA and VA loans? She said 6.5, 6 3/4. So less than the 7.5 in a traditional conventional 30-year mortgage. But I'm surprised that they're so busy, even with their customers paying 6.5 and 6 3/4. That also tells me there's a lot of pent-up demand for housing. And so I actually, the banks that I talk to feel like, yeah, they don't like that their deposit costs are going up, but they don't seem like they're that short of activity. Projects to lend to, whether it may not be offices for commercial real estate, but there are a lot of other segments in commercial real estate where people seem to be turning to banks and there's still economic activity.
Yeah, that's interesting. During my lifetime, a 5 to 6% interest rate or mortgage rate has been pretty normal. I mean, when I got my first home, it was like 11 and 12%, and so which was terrible. But 2 to 3 was really pretty crazy. How did it get that low? What made it that low?
Well, I think it was a combination of factors. Remember when COVID hit, tremendous uncertainty about what the economic future held. I mean, in the moments, go back in time, some unique things happened when the pandemic hit. Back in 2008, when we had the financial crisis, investors fled. They wanted to get out of the mortgage market. They wanted to get out of stocks in many cases, and they ran to U.S. Treasury bonds as a source of safety. So there was a global demand for U.S. Treasury bonds because people said, we're going to be safe in treasuries. The darndest thing happened that we've never seen before. In March of 2020, there was so much fear in the world about this pandemic that no one knew how contagious it was. No one knew how deadly it was, what was going to happen. Were you able to go to grocery stores and get food? People just wanted cash. They didn't even want treasury bonds. They just wanted cold, hard cash. So there was huge demand across the banks and across the Federal Reserve to flood the economy with cash, to meet those needs for cash. And So Treasury markets ended up freezing up, and the Federal Reserve had to step in to try to provide liquidity to calm things down. So we had a lot of different emergency interventions to try to stabilize financial markets at that time. And there was a lot of stimulus coming from the government. Those combined actions helped to drive interest rates across these securities down, including mortgage rates, which ended up then translating into a very attractive mortgage rate for families who wanted to go out and either refinance or get a new loan to buy a home.
A lot of investment decisions are made upon the 10-year interest rate, as I've heard you say. And right now, we're kind of in an inverse situation. The 1-year, 6-month, 1-year deal is well higher than the 10-year deal. People have suggested that basically that's maybe because the Fed is holding too many securities, Treasury bills, and needs to unwind some of those. Can you kind of explain what I'm hearing some people say about that?
So this is